And yet today, if I had to say what proportion of investors are bullish versus bearish, it's really risen in the last year.
How would you think about that? How would you respond to my concerns there?
You're almost kind of mirroring what we're observing, but just with a different take. I mean, our take is markets climb a wall of worry. Historically, when there's a lot of skepticism, stocks can rise. In fact, markets actually peak on good news. They don't peak when people are bearish. Markets peak when everyone's bullish, and it no longer responds to good news. Just like markets bottom on bad news. And I think many people are skeptical, but stocks have risen. It doesn't really mean markets are shrugging off the concerns. That's one way to interpret it. My other interpretation is, there is a wall of skepticism. And I mean, maybe that's just it is like, maybe we're just talking about the same sides, just of the same thing. And, but like if someone asked me, is it worrisome? I was a technology analyst in the 90s, so I covered wireless stocks starting in 93, and I witnessed the bubble that was created, a decade in the making, really 2 decades in the making. And by 99, not only was there no skepticism, there was excessive entitlement. Investors were expecting stocks to do explosively, and a 20% upside wasn't satisfactory, and valuations were already elevated and expanding. So I'd say that if I was trying to compare this to the bubble of the 90s, and wireless was a central cast character in that internet infrastructure build, where I don't really see the echoes of that today.
Do you think those would be the trigger of such a correction?
Let's start with the one that you just mentioned. The stock market, we're up 16%. So I think if we rally 3 percentage points, we'll be 3 years of 20% gains back to back. And it's actually more common than we realize. In fact, when we look at the last 65 years, it's happened in 20 times in different countries, and multiple times in the US. 12 times. It means a lot of good news is priced in. I mean, of course, stocks being up 20% a year, 3 years in a row, it's definitely pricing in a lot of good news. So to me, I do think that we have to consolidate those gains. And that's why I think a drawdown next year makes perfect sense to me. But because there isn't a lot of leverage in the economy, household sector has not really borrowed money. It's been expensive to borrow money, and even margin debt, it's risen, but it hasn't risen parabolically. So it's actually essentially tracked S&P gains. So it's not like people are borrowing faster than the market's been going up, especially if you look at a 5-year CAGR. So I would be in the camp that as long as the economy's holding up, that drawdown is going to be viewed as a buying opportunity. Now, on AI valuations, it makes perfect sense for someone to say a lot of the valuations for AI are probably absurd, because this is the nature of a exponential sector, right? If we look at an industry that could grow parabolically for 10 years, all of the future value is in the latter half of those years, right? So and then we're trying to discount that back to today. And so stocks are going to look absurdly expensive. And more importantly, investors make a common mistake, which is that they assume that the existing universe of companies are going to be the central cast characters over the next 10 years, which is not the case. So the reason valuations don't make sense today is that, one, of all the AI stocks, I'd say it's probably safe to say only 10% are going to be good investments. Maybe it's even generous, maybe 5%. And of course, there's going to be a new emergence set of new players. And in fact, the economic model might change. But it doesn't mean it's a bad investment. And we've highlighted this as generational trades in past reports. For instance, like if you look at the internet, if you bought the internet basket in 99, okay? So you bought it near the peak and you held it to today, you actually still outperformed the S&P 500, even though 99% of the stocks went to zero. So it was a bad investment if you tried to pick a winner, but it wasn't so bad if you held it as a basket. So I think AI, it's probably going to be fair to say 90% of the stocks are going to do way worse than people expected. They were too optimistic. But I think as a basket, it's probably going to outperform.
Why are you so bullish on 26?
I think the economy and stocks have been suppressed for the past few years. Part of it is, of course, that we've seen 6 what I call extinction events take place in markets. Everything from COVID to the bullwhip supply chain effect as the economy restarted, to the fastest inflation cycle in history, and then followed by the fastest Fed hikes in history. And then we've, of course, had a very controversial administration which put tariffs in place in April of this year that caused a miniature bear market. And then we've even had the U.S. bombing Iran's nuclear facilities. I think all of these collectively have made investors very nervous about what I call investing in full risk, because these are what 6 black swans that happened in 4 years. And I think on top of that, we've had a Fed has not really given a green light about monetary easing. And I think the Fed's reluctance has actually suppressed business, quote, animal spirits, because the ISM has been below 50 for more than 3 years now. So I think that's all been a business cycle that has been pretty good, but not one that has been really expansionary. And I think that starts to happen next year.
What do you think about that label? And how is it that you are bullish right now in a sea of bears? And what do you think that says about who you are?
I was first called a permabull in 2009. And in fact, it was major newspapers that were using it as a mocking term. Here's what's interesting. 16 years later, what was the right call to be?
Oh, the optimists have won.
And yet today, if I had to say what proportion of investors are bullish versus bearish, it's really risen in the last year. In fact, it's kind of close to the 2009 levels. I think people are already betting on the fact that we're in a bear market. And now, many people were convinced of that in 2022 because of the Fed hikes, and they just never changed their views 3 years later. But as you know, what made people a lot more bearish is also because President Trump is a very unpopular president. He's a very divisive figure. I'm a registered independent, so I have never tried to let politics be involved in how I view markets, but I can't help notice that I think that political lens plays into many of our clients' views around markets, that they tend to view. When Biden was president, there were a lot of people who were critical of Biden. I thought the economy, I've cared about the economy. I thought the economy was fine. I think the economy's still doing fine under Trump. So that's kept me, I use that as one level of coding that I think has kept people bearish. But, you know, I think America is, as long as it's a place of innovation, and we are, because we're at the center of AI, I think it's pretty bullish. But you guys have raised the key point. I mean, there's a chance that this AI is a disaster for labor markets. And if it is, the U.S. will be the least scathed, but everyone's going to go down.
Do those companies, do the big tech companies, the Magnificent Seven, do they count in your analysis of AI valuations being too high and the possibility that perhaps we might lose out or that the value won't actually show up for many of these companies?
I might even just add to your concern because there's a lot of CapEx here too. So that these are, a lot of the Mag 7 used to be asset light businesses. The remarkable equity, rent-seeking model of them was that they could create growth with very little spending. I mean, R&D spending was there, but really CapEx was not there. But today, as you know, AI is extremely capital intensive and it's energy intensive. And it's only justifiable if it's replacing real work somewhere else. Then you can justify, because now it's creating assets to replace future OpEx, I'm going to give you a spin about what's happening that is not disagreeing with what you're saying, but it's probably observing a change in the reality, okay? Which is tech companies are becoming a bigger part of our life. So naturally, they're going to have a larger share of spending. By the way, we wrote about that in 2018, that if you go back to 1930 and you just use simple demography, population tables, whenever the population growth rate grows faster than the prime age workforce, which means you have compounded labor deficit, you've always had a technology cycle. That was 1948 to 67 and 1991 to 99. In both of those periods, the population growth rate was growing fast, which is demand, faster than worker supply. And we entered the third epoch or era of labor shortage, which started in 2018 and it's going to last to 2035. So then technology spend is necessity because you don't have as much labor available, so there's going to be less wage spend.
Yeah.
Now, if I substituted the word and called this, instead of the word banks, tech companies, I called them financial institutions, we would not be saying there's a financial institution bubble, because for every unit of GDP growth, there's a unit of financial spend. I mean, it's literally the other part of the ledger. And in fact, the financial industry has all circular spending. I mean, think about this. Real estate is valued as a separate asset, but every company needs real estate just to run a business. So why are we valuing real estate? Like in a GDP sense, real estate should be an interim product, not a final product. So I think tech is becoming so central to the economy, especially because of labor shortage, that when we see tech intensity growing, people are flagging that as a bubble, whereas I'm actually just pointing out it's actually out of economic necessity. But it becomes a bubble if the multiple we're applying to the tech streams don't justify higher valuation. I think tech earnings are probably more valuable than Costco, for instance.
Yeah, agreed.
Or Walmart, right? But Walmart trades at 37 times forward earnings and Costco trades at 50 times. So NVIDIA trading at 27, I mean, is there a bubble in Costco and Walmart because NVIDIA is at 27 times earnings?
Do you still believe we're going to be in a cycle of labor shortage even with AI?
I vacillate because there's times where when I read a book like The Coming Wave, I panic and I realize wow, we need to re-educate society. But one thing that gives me hope is that we did at Fundstrat study another technological wave that wiped out at least 20% of the labor force in the 20th century, which was frozen foods. So what many people don't realize is that when Charles Birdseye created Flash Frozen, which, by the way, was a venture backed by Goldman Sachs. It was a VC-backed company.
I love this.
And by the way, his name is Birdseye because he was an ornithologist. He actually was studying birds. But he found that the Inuit tribe in Alaska had kept their fish super fresh, and it's because they were putting it in a frozen saltwater solution that flash froze the fish. If we look at the labor tables from the 20s, 40% of the U.S. labor force was employed on farms. It was literally, most of the economy was people working on farms, and most of the service sector that was defined back then were household servants, people working for someone else. Food was over 25% of the wallet prior to frozen foods being widely, mass market, because most food spoiled on the way to the supply chain. And so grocery aisles were mostly fresh, and what was frozen back then had freezer burn and was terrible. So flash frozen allowed suddenly the cost of food to drop dramatically because you had less spoilage, and the number of people working on a farm today is down to 2% of the U.S. workforce. So flash frozen was really the key innovation that brought down the cost of food from 20% of the wallet to 5 or 6% today, and reducing farming labor from more than, I think it was 40% at the peak, down to 2%. An economist in 1920, okay, let's just pretend on CNBC in 1920, there is none, but let's say there was a CNBC in 1920, and these economists were saying, frozen food, if it comes along and it's going to wipe out 95% of all farmers, this is going to wipe out the U.S. economy. The U.S. economy can't survive frozen food. And instead, it freed up time, right? And it allowed people to be repurposed, and it created a completely new labor force. So Scott, to your point, I think that there is an adverse outcome, but then when I look at past episodes of huge labor disruption, it's actually had positive outcomes.
What are the kinds of skills that makes you irreplaceable as an analyst? What kinds of things should white-collar workers, working professionals in general, be trying to work on and be trying to hone in order to not be replaced by AI?
AI is very good at looking at the past. So if you need to build a model, you need to recall data, even say, give me the last 12 times something happened. That is AI. But as you know, to do true training, then you need to have it work in the future. Now, future has not a binomial outcome. It's multiple forward scenarios, and the probabilities are unknown of each future event, okay? So you're dealing with so much uncertainty that I don't know how a probabilistic way to give you a single point answer would ever work. I mean, to give me an example, someone will say, this is the fair value of a stock, and they say this is the PE and this is the E. And I can never understand that, because I'm always wondering, which E are you using? And you know what I mean? Like, because price is today, but then which forward metric, and then how do you discount it? How do you explain to AI that you have to look at 10 years of future earnings, but you don't know which future earnings will actually matter the most? And then how do you assign the weights? I mean, that's really what we do at Fundstrat, is we're constantly assessing the probabilities of future events and then deciding. We do have to pick a direction, right? Then we say this is the path we're going to take, but it's a guess. So I think that the best qualities of a researcher, at least in my opinion, are you do need to be unemotional, but you also need to know the difference between conviction and being stubborn. Because stubborn is riding something and believing in something when all the facts have changed. Conviction is basically riding through the volatility, and it's not easy to tell the difference until history has already passed. And I think, the third thing that's really important in markets is to know what's already priced in. I don't know if AI is going to really have a good sense for, like, if AI is the only thing managing money in the future, I think a human will beat the market, because all the AI systems will be predictable. You know what I mean? And then you can spoof them all. So that's really where I think human judgment matters, because, I'm constantly surveying our clients, and I'm in constant touch with them. So I kind of know where the money is and what the bets are and how they react to the Fed. And I don't know how you can program AI unless it is, well, they'll get very good, but they really have to think not just on a specific outcome, but on a series of future outcomes. And that's what we're always sort of obsessing over.
Where do you stand on Bitcoin right now? Do you still believe that we could hit 200K in January? What do you make of what's happening in the crypto markets?
Well, crypto's had a rough year. It was actually having a great year until October 10th, because on October 10th, Bitcoin was up 36% for the year. And now it's currently, I think it's like flat for the year. So it lost a lot of its gains. I'm still very optimistic because crypto still has its best years ahead. But crypto should have had a good year this year, and it was on track to until there was a liquidity crisis on October 10th. That was a bigger wipeout in terms of liquidation than any event in history. The most recent one before this would have been 2022 with FTX. And that wipeout pales in comparison to what happened on October 10th. But in 2022, it took 8 weeks before crypto, the smoke cleared, the leverage wipeout was nothing to mirror that crypto prices began to recover. This week is the 8th week since that crisis. And I think crypto prices are beginning to actually recover. That's why I think Bitcoin can double from here by the end of January. Now, many people don't expect it because of the 4-year cycle. And that's going to be the big question. If Bitcoin breaks 125 in January, there is no 4-year cycle.